We're back with another episode of the podcast. It's September. Kids are back at school. Ernest, everybody is always asking me, is September notoriously a bad month for markets? Should we be nervous? And for good reason, I guess. Recently, I look back, the last few Septembers have not been good. But, you know, what I tell clients is every day that ends with Y is a tough day in the markets. And every month is a tough month in the markets, and it doesn't go in a straight line. And, you know, if we knew what month would be best for the markets and which days and which stocks and this and that, it would be a different story. I think we know the right process to make money in the markets, which is owning good quality businesses, holding them for the long run, doing a lot of research on them, investing with strong management teams that can create value. We've said it a million times. That's the process we like to stick with instead of dancing in and out of the markets. Any thoughts about the seasonal effects on stocks, and does it have any value to those that focus on long-term investing and trying to be business owners?
I think it's basically the equivalent of astrology.
Yeah.
Financial markets. There's no underlying logic to it. And I think it's a distraction.
Yeah.
It prevents you from looking at things that ultimately matter, which is the fundamentals of the business.
Mm-hmm. You and I were talking off air before we pressed record on the podcast about people never forgetting the large mistakes that you make in investing. When you're buying individual stocks, Ernest, and our clients own about 30 to 35 names right now. I've been doing this. This is my 24th year at Baskin Wealth. I probably in my entirety of this business working here, we've owned 400 or 500 different stocks. Of course, you're going to make crazy bad mistakes.
I think the key is that's why you own more than one stock in your portfolio.
Yeah.
So that if you things happen, maybe your analytical process was flawed, or maybe just bad things happened to the company. Yeah. But that's why you own 20 or 30 stocks, so that if one of them does go poorly, then you're not wiped out of the game.
Absolutely, you're not evaporated. And you can only react to the information that you have at the time. And when we're selling, when we are making a sell decision to get out of a name because we're scared about the future, clearly something really bad is happening to that company at the time, whether you're going through a pandemic or some type of crisis or a balance sheet implosion, or something has changed so quickly in the competitive landscape and you made the decision at the time, you thought it was the safest thing to exit, protect the client's money, maybe your own money as well. And that's the information you had at the time. And then for someone to remember that, I get people tweeting me about stocks that I haven't been in them in 8 years, 10 years, so reminding me how dumb I was, and giving us no credit, of course, to any other good moves that we may have made in our portfolio.
I think a common theme among the big mistakes that we have made, is less so that it's never been a valuation issue, mm-hmm. where we should have sold at a higher PE ratio or anything like that. It was actually fundamental issues that happened with the business that maybe there was a balance sheet issue, or maybe the business had some secular decline.
Yes,
right?
Yeah.
Those are really ultimately what get you, rather than if you're paying a multiple that's a little bit elevated in the near term.
Yeah. I really think, and when I look at some of the mistakes we've made, I'm not going to talk about that stock that people keep harping me about, but thinking about Viacom, which is now Viacom merged with CBS, became Paramount. That was those two companies merging was no beneficial at all, because the media business is in secular decline unless you're Netflix.
There's a big fight for Paramount today.
No idea why anybody would want it, but I guess the media library has some value. That one, of course, one of the big mistakes that I made there was thinking that the company buying back the stock was going to create a lot of value. And we had done well owning a number of companies that had were very aggressive on share buybacks and had done very, very well, like a DirecTV years ago that got taken out. All it did was buy back stock, the Malone playbook. And I think Viacom also followed the Malone playbook, but it didn't work out. But I think when I look at the mistakes that we could make in the future, what I want to avoid, of course, is companies buying back stock with lots of debts, business going into secular decline. Those are the things that I think can really hurt you instead of a valuation, which you rightly pointed out.
Yeah, and I think that's especially relevant today because there's a lot of investors, in social media that are pitching certain names that I won't name. And the whole thesis is the stock is maybe 50% lower than it was a couple of years ago, and trades at maybe 13 or 14 or 15 times the consensus estimates for 2025. And the issue with that logic is that these are usually these are not great businesses.
Yeah.
And by that, what I mean is that if something bad happens, which has been happening for some of these companies, let's say revenues drop by 2%, costs go up by 3%. These are very low margin businesses where the profit can fall 30 or 40% very, very quickly. And then your multiple, your 15 times earnings, suddenly becomes 30 times earnings.
Yes.
And then the company doesn't look so cheap anymore, right? So that's one of the issues that's one of the flaws that I often see from investors who are trying to bargain hunt.
Yeah. I think with growth names, of course, if it's trading at 30 or 40 or 50 times earnings and the market decides that was just a ridiculous multiple to apply to those companies and now they should trade at 20 or 25 times earnings, you're going to take a nasty haircut in the short term. But hopefully over time, if it's a great business, the earnings of that company will continue to grow. And even if you get hurt on the multiple reversion back to whatever it goes to, you'll be saved by the earnings growth. But if you're in a business where it's, like you said, 15 times earnings, in secular decline, may never recover, I don't see how you're ever going to be saved.
No, and I think that's kind of almost the definition of a value trap.
Yeah.
It's that you bought a stock, things are not going well, but then you don't sell and maybe even buy more because the multiple is cheap. Yeah. It looks cheap. And you think, well, if they only do this, then the stock can go up 20 or 30%. Yeah. But then what often happens most of the time is that things get worse before they get better. Yeah. There might be management changes. The balance sheet usually requires fixing. So all of the cash flow is going to that as well. And so it's hard to turn around businesses, like Buffett says. So,
Ernest, I was recently interviewed on TV, and we talked about the revival of yield stocks, which is very good. I want people to make money on the stocks that they own. And a lot of these dividend payers, especially in Canada, with interest rates being cut. Today is September 4th. We've seen another rate cut in Canada. So I think that's 75 basis points and probably more rate cuts to come in Canada over 2024 and 2025. And as interest rates get cut, it makes GICs, money market, cash-like products, obviously their headline yield less attractive. And so in Canada, we really don't have a high yield market. So some money in GICs as they come due, people were getting 5% or 6%. Now they're going to get 4 or less. They're going to say, well, I can't live off that. And I'm going to have to put it into something that has a more higher yield for me because I need the income. Naturally speaking, money would flow to some of those more dividend-paying names. But you can also get trapped in them as well, right? Because let's say in 2 years from now, rates go back up again. If they're not great businesses, if they're not businesses that are not growing or their balance sheets are not getting better or they have no way to reinvest the cash flows and everything comes out as dividends, you may look good for a year or two and then you're back in the same situation. Your take on what I just said?
I think ultimately, as an investor, what you want to avoid is the trap of thinking that equities and fixed income are the same thing.
Yeah.
Because they really aren't, right? Even within the same company, like take Bell Canada, for example. There's a reason that the equity yields different than the fixed income. You can buy Bell bonds at, 4% or whatever.
Yep.
And the equity is yielding 8%.
Yes.
It's not free money. Like there's a reason that the equity is yielding the 8%. Mm-hmm. It's because the market is questionable about, regulation or whatever.
Yeah.
Right. And so just to say that just because rates are going to fall and therefore the equity is undervalued, doesn't make a lot of sense to me if you're just purely looking at the fundamentals of Bell Canada.
I think it's very rudimentary to say, okay, so the bond yield is 4%. It used to be 6%. As bond yields go down, something that's paying a dividend of 8% has to be that much more attractive. Maybe.
Yep.
But maybe, as you said, competition has increased, regulation has increased, the businesses, the telcos are going to be facing a lot of issues going forward. Isn't Amazon and Tesla, not Tesla, but Starlink,
yes,
throwing up a lot of satellites in the sky to get satellite internet and broadband? That could be a game changer.
And in first year of finance class, mm-hmm. you learn that the lower the yield on a product, the greater the sensitivity it is to interest rates.
Yes.
So if your entire investment thesis is that rates are going to come down and then therefore your yield product is going to go up, what you should be looking for are low yielding products. You should buy a 30-year bond, mm-hmm. right? And that's going to go up the most if your expectations for interest rate coming down happens. Mm-hmm. You shouldn't be buying something that's yielding 8% because that's not where you're going to get the upside from.
Yes, yeah. I think
not to say that we are making that kind of bet.
We are not making those type of duration bets. In our history, we have stayed away from betting on duration and really focus on owning quality bonds and focusing on a ladder. But I think that's the right approach. If you really thought yields were going to come down a lot, you would go long, very long bonds. Yes. You wouldn't buy crummy dividend payers. One of the things that I want people to focus on, of course, is the free cash flow, what's left over. So I see a lot of these so-called dividend-paying stocks where the yield is high and people are attracted to them, but you have to do the math, right? After capital expenditures, after depreciation, after all these things, is there any cash flow left over if something bad happens or if they need to get growth? I don't want to pick on on any one name, but I was looking at Enbridge, for example. Enbridge has a return on invested capital about 6%.
You are picking on them.
I'm picking on them. So what does that mean when you're only getting a 6% return on invested capital and the dividend yield is 7%? And, what's your take on that?
No, I think at the end of the day, your return is going to be what the returns that the company is earning on its own assets.
Correct.
And so if we want to maybe talk about this a little more positively,
yes,
I think if you do want dividend paying names, I think the midstream sector in general, especially the ones that are focused on moving oil and gas in and out of Canada and within provinces, I think that's a pretty good place to look because those are generally unregulated businesses. Generally, they have decent returns on capital. They have some healthy tailwinds coming out, increased oil and gas production mm-hmm. over the next couple of years. And they are yielding, 5, 6, 7%.
But at the end of the day, Ernest, as you said, it's what you put in, what you get out, right? If your returns from the business are not greater than 6 or 7%, that's the best you're going to get. It may wobble from here or there, depending on where rates are, the business outlook, where you are in the business cycle, but ultimately, that's going to be your return over the long term.
Well said.
Okay, well said for you as well. So we got a bunch of topics we want to hit today. You want to do a quick update on Couche-Tard because that was our last podcast. We've done a number of podcasts on Couche-Tard. Our earnings releases tonight. We've already seen from a couple of U.S. retailers focused on convenience that things haven't been so excellent in retail as well. And Couche-Tard, the last few earnings reports have said that retail for them has been tougher, but we're expecting better margins on fuel. But of course, our latest podcast was about Couche-Tard and its proposal, a whopping huge proposal to buy the parent company of 7-Eleven. I think it could be a $35 billion U.S. deal. And the parent company is in Japan, and there's been some news since we've done that podcast.
7-Eleven is still thinking about it. The board is still studying the proposal, haven't made any decisions yet. But the Japanese government did say to 7-Eleven that they are not allowed to use the national security designation as a cover to prevent themselves from being acquired.
Okay.
And I think observers of the Japanese markets were they were supportive of this, because one of the things that the Japanese government has been trying to do is liberalize their financial markets and make it easier for foreign investors to come into the country, and this is another step in that process. So it's probably good for Couche-Tard's efforts in terms of their attempt to buy 7-Eleven. Mm-hmm. I think it's kind of like a wink from the government that, look, we're gonna be supportive of the process. Maybe in the end we won't necessarily approve it, but we want to invite other companies to invest in Japan. And so we'll see what happens with that.
Okay. Anything else to touch on with Couche-Tard?
Well, one of the things that I thought was interesting overall is that there's been a lot of discussion overall about, this is not Couche-Tard specific related, but there's been a lot of ink spilled about why the U.S. markets outperform the rest of the world, and why they have been over the last
very long time.
Period of time.
Yeah, I mean, we looked at the MSCI returns for China, for Mexico, for emerging markets, for Canada. I mean, the last 3-5 years, some of them pretty good. Admittedly, the markets have done well the last 3-5 years, so all except for China. But if you go back 10 years, it's really pathetic. I think I saw Mexico 3% compound return over 10 years, Canada 5%, China 0%, emerging markets, I think it was 3%. So not great versus the S&P 500, which is what, the 10 years, double digits.
Yep.
Yeah.
And obviously the quality of the businesses, all the largest technology companies, the innovators, they're all generally American companies, right? But I think one factor that is understated in terms of why North America or the U.S. market outperforms is that the U.S. markets, more so than probably any country in the world, is the one that is really focused from a corporate governance perspective on shareholder returns. Mm-hmm. The board exists, obviously, to varying degrees depending on the company, but boards exist to maximize shareholder value. Mm-hmm. That's, as I travel around the world, you begin to realize how unique of a phenomenon that is. Because in places like Hong Kong, or maybe even Japan or South Korea, or even in Europe, probably.
Yeah, you don't have to pick directly on Asia, but yeah.
The companies there, not to say that it's a bad thing necessarily, but the boards there are not thinking necessarily about maximizing the stock price. Mm-hmm. So if you have a controlling family that owns a large property company in Asia, their primary concern is not to maximize shareholder value. Their primary concern is usually control of the business, making sure that they might employ a lot of their family members in the business. They might have a special voting class that gets more dividends. Mm-hmm. And so I think that's a unique aspect of the American markets, which contributes to long-term returns in the long run.
Show me the incentives, I'll show you the outcome.
Right. And that's why if you can, let's say in Hong Kong, mm-hmm. there might be these property developers that are trading at 20% of their property value, right? And if you look at it on a stock screener, it looks, you think, wow, this is amazing. I'm buying these crown jewel properties at like a massive discount to their book value, but the stock price never goes up because the management isn't doing anything to take advantage of these discounts.
Yeah.
Whereas if you were in the US, there would be activists and they'd be trying to get them to sell properties and buy back stock and all that stuff. So I think that's another reason why it makes sense to invest in the US.
Yeah. Well, we've seen the massive returns from these large tech companies over the last few years. You know, companies that had, I don't know, a few $100 billion market caps becoming multi-trillion-dollar market caps. Do you think we're going to see that phenomenon again? I mean, obviously impossible to know where the next trillion-dollar company comes from. We have a lot of companies in the U.S. that are worth 500 billion, 600 billion, 700 billion that eventually should become trillion-dollar companies. But is it now a winner-takes-all type market? You know, we've seen a lot of people talk about this race, the spending race on AI, in hopes that this is going to be just a gigantic opportunity, whether it's humanoid robots or what have you. It's so hard to know the outperformance going forward for U.S.
Yeah, I don't want to spend too much time on this topic, but I think one of the things that has been kind of interesting about the large techs is that these are increasing returns to scale businesses because historically you have, like, if you were, let's say, you made a software in like one part of the world, it was not necessarily translatable to another part of the world, right? But then you have the internet coming and making it a global phenomenon where Microsoft can sell Microsoft Word in one part of the world to another part of the world, and it's the exact same software. And so as the business grows, it's becoming a better business. And that's one of the reasons why these businesses are so big and so profitable at the scale that they are.
Pretty fascinating. So topics you want to discuss today? I'll let you kick it off, Ernest.
So we've been talking about rates. I think one of the topics that I think has been pretty interesting is the gap in performance between the Canadian banks.
Yes.
Like, oftentimes people talk about the Canadian banks as if they're one monolith.
I know lots of people that own all the Canadian banks, right? It's and that's all they own, and they think they're diversified. But anyways,
no, but then what's interesting is that if you look at even the year-to-date performance, you have Royal Bank and National Bank. They're doing very well. Share price up like 20% or whatever. TD is doing lousy. And then you have CIBC and Scotia and BMO.
CIBC's actually done quite well recently, and looks like may have fixed some of their issues. It's now probably the third best performing bank in Canada over a multi-year period. BMO kind of with it, and then Scotia and TD near the bottom. We won't talk about Laurentian Bank or Canadian Western Bank, of course.
Right, and that's not kind of what you would expect if all of these were the same company.
Yeah.
You would expect that the performance was essentially the same, that they're being driven by the same macroeconomic factors, right? And so it seems like the banks that are focused on domestic Canadian businesses, those that have large wealth management and capital markets businesses, especially in Canada, those have been outperforming the banks. And so those would be essentially Royal Bank, National Bank, and CIBC. They are outperforming the ones that are focusing internationally, especially in the US, which would be TD, BMO, and
Scotia.
And the reason for that is because, number one, the returns in Canada, even though it's a fairly consolidated market, are generally better. The Canadian banking market, for whatever reason, offers higher returns on equity than U.S. banking, which is a much more competitive market.
8,000 banks in the U.S. versus a handful of banks in Canada, and of course dominated by the big five, the big six.
And especially those that, like National Bank, which we own, they are focused on, within Canada, they're primarily focused on Quebec, which is a very different market than Ontario or BC, which generally have generally viewed to be more sensitive to housing-related risks.
I'd also point out that both National and Royal are excellent at cost controls. They both have amazing efficiency ratios, which means that they're generating a lot of dollars, and keeping costs well under control. And it's not a one-year phenomenon. It's been that way for a very long time. In banking, lots of bad things can happen that are beyond your control, but you can control costs.
Yes. And one of the things that all of the banks remain concerned about is mortgage renewals.
Okay.
That is taken on, like it's been in the headlines about the coming wave of mortgage renewals in 2025.
Yeah.
And some of the banks actually gave pretty good numbers to this. They say that for the mortgages renewing in 2025, the average fixed rate mortgages, the average payment shock is about 15%.
Okay.
On renewal. So that's about $200, $300 per month per borrower, or about, $2,000 or $3,000 a year, right?
Yeah.
And it's not nothing.
Yeah.
But it's also not catastrophic for a family that is earning, let's say, $100,000 or $150,000 of combined household income.
Okay.
So put together, I think the outlook for Canadian discretionary spending, so spending on things like travel, restaurants, and so on, is probably still going to remain weak.
Yeah.
Even though there's been interest rate cuts coming. But I think they'll be able to figure it out.
Yeah, I would hope that the people would get a cost of living increase of 2 or 3%. Yeah, and even if they're making 100 or 150,000, their mortgage goes up by 15%. Net, it shouldn't be that bad a hit. And of course, we're now seeing rates being cut, right? So maybe people won't be able to renew that 2% mortgage at 2% ever again.
Right.
But I don't think it's going to be catastrophic where they're renewing at 6%. I haven't checked to see what the 5-year mortgages in Canada are. By the way, Ernest, have 30-year mortgages been approved in Canada, and are they available now for Canadians to start taking advantage of? Not that we're giving any recommendations to do that, but...
So don't quote me on this, but I believe they've been approved for first-time home buyers.
Okay.
I don't know if banks are offering them yet, but I don't think, I'd have to look more into it.
It would have been wonderful if those would have been available during 21 and 22. But them's the breaks.
But they're still renewing after 5 years.
Yes.
Just because the amortization is 30 years doesn't mean you locked in 2% for 30 years.
Gotcha. Okay.
The term is still 5 years.
This term is still 5 years. What's pretty interesting, of course, in Canada is now that interest rates are being cut, people may be more attracted to going with variable rate mortgages, right? Because it does seem anything can happen and anything can change. The world is so unknowable, but it does seem that with rate cuts in Canada, already 3 25 basis point rate cuts, potential for many more. We read the press release today from the Bank of Canada that they want to get growth going again. They're not happy with what's going on, and they see inflation coming into the target range. So one could expect multiple rate cuts. Although the last time, if you listened to Tiff Macklem, when he told everybody to go out and buy a house and don't worry about your mortgage, the world changed. So predicting this stuff is near impossible.
Well, one last thing I would say is that a lot of this will end up depending on the economy as well. Because I think one thing that is not commonly appreciated is that mortgage rates for fixed mortgages are not tied to the government central bank rate.
Correct.
They are tied to the 5-year bond rate.
Yeah.
And that, there's less ability for the government to be able to control that. That is dependent on bond prices, which are depends on the market's outlook.
Yeah, but when you raise rates and you fight inflation and inflation comes down, then the 5-year,
yes,
they do have...
It's linked, but it's not a direct correlation.
Correct. Each cut in interest rates by the Bank of Canada doesn't necessarily affect the 5-year mortgage rate.
Right.
But it will affect the variable rate.
And it certainly helps the variable rate borrowers.
So a variable rate the reason a lot of people got into this mess, Ernest, is because variable rate mortgages in Canada have always been the most popular place to be, right? And for good reason. We had a 30-year plus market where interest rates went down.
It's the perfect long-term investment.
That's right. So you had, we always hear from our older clients or that, oh yeah, my first mortgage in the 80s was 18%. Imagine if we had the renewal mortgage today at 18%, we're dead.
Yes.
Which reminds me about, just I'm going off tangent here, but did you read the headline where Americans have the most money ever in the stock market today versus?
I did see that.
Yeah. It's kind of a stupid number because if you compare it to 20, 30, 40 years ago, people were getting 10, 15, 20% on their, I wouldn't call them GICs, but on their bonds, on their money market like products. Today they're getting the blip last year where they moved up to 5%, that's over. Generally speaking, over the last 30 years, rates have gone down. So of course you're going to put more money into the stock market. Where else are you going to get returns from?
Exactly.
Yeah. So, you have to, whenever you read these headlines, you always have to do some due diligence to make sure it makes any sense whatsoever. Context is very important. Okay, next topic.
How much time do we have left?
You can keep going.
Okay.
We're the bosses of how long this podcast lasts for.
So one thing that I wanted to talk about was, Berkshire reached $1 trillion in market value right before Buffett's birthday.
How old is Buffett now? 93?
93.
Wow. So $1 trillion market cap. It's the first.
As we were just talking.
Yeah, as we were talking, it's the first non-tech company to reach $1 trillion market cap in North America. I think Saudi Aramco has $1 trillion market cap, but
it's not North America.
Yeah, not North America, so we don't care. But and Buffett did it, of course, by selling lots of Apple recently, sitting on a lot of cash. The results in the core business are really been unexciting the last few years. Moving in the right direction. Like I'm not gonna. I'm shareholders of Berkshire. We own it for our clients own it too. We love it, but the last few years hasn't been like an Nvidia type growth or Apple type growth.
No, some of their businesses have actually done pretty poorly.
Yeah.
The Geico has been losing market share.
Yeah.
They were totally earnings have been down quite dramatically.
Railroad not so good. Utility terrible.
Yeah. Can you imagine if Berkshire did quarterly calls?
Yeah.
Where analysts were asking them about their plan to turn around Berkshire Hathaway Energy.
Yeah.
And those kinds of things.
That's right. And he's got some lawsuits on his hand with the wildfires in the US. I mean, it's not a great outlook. So how did it get to $1 trillion market cap?
Because Buffett is, first of all, their largest position is Apple, which continues to do really well.
Amazing. Yeah.
They have a gigantic amount of cash, and for whatever's going on in the business, they're still generating a lot of cash that is reinvested within Berkshire. Well,
that gigantic amount of cash is also in treasuries, which he shrewdly bought at 5%. So he's got a few $100 billion earning 5%, which is very beneficial to the bottom line earnings.
And I think one of the things that I think this is a really good lesson on the nature of just reinvesting earnings, because if you have a profitable business and you're not paying it out as a dividend or a buyback, then by definition, your business is getting more valuable day by day, just because of the accumulated cash that's sitting inside your business.
The most recent purchase by Berkshire was a nice stake in Chubb Insurance, and many are speculating that that's just an entry to eventually take over the entire company. As Buffett knows and loves insurance, we'll see if that happens. He's also been buying a lot of Occidental Petroleum. Of course, oil prices have not gone in the right direction, so that has not been a winning investment. And he should have listened to us and bought Canadian Natural Resources, much better company. But your thoughts on Buffett at age 93? I don't think he's been in the media recently. He had his annual meeting in May, but I haven't heard very much or in any interviews. I guess that's typical Buffett. He's really quiet until there's something to talk about.
I think he's getting old.
Yeah.
like which is not anything mind-blowing to say.
Yeah.
But if you look at the last AGM, he's been definitely delegating more to his deputies. He couldn't even remember the name of the company that Greg Abel was sent up to evaluate in Canada.
Okay, yeah. That was home capital. Yep.
He couldn't even remember the name.
Yeah.
And I think he has definitely pulled back on his like just general involvement with the business.
And this is a guy that knows everything and every company that he's invested in. But we'll at age 93, still a tremendous brain and tremendous capital allocator. And I'm excited to see what he does next with the large cash balance that he has, given that at some point rates are going to come down and he's not going to get 5% anymore.
There's a lot of cheering
Yeah.
when it was revealed that he sold his Apple stake.
Yeah.
I think at the end of the day, like don't worry about what other investors are doing.
Yeah.
Just focus on your own portfolio, and because that's ultimately what matters.
That's right. I'm not going to listen to random Twitter person or random fund manager or even well-known hedge fund manager. They're going to do what they're going to do, right? We had 2 stakes that Bill Ackman owned that he sold. Domino's Pizza, Netflix. I mean, he's a great investor. We respect him very much. We don't care. We're going to do our own research. And your time horizon as an investor is completely different than the time horizon of a hedge fund manager or some other random person, right? So that person may be absolutely right to tell you, yeah, you should sell that stock because it's going to do lousy in the next few months. They could be absolutely right, but it may do spectacular over the next 10 years. And so it all comes down to your time horizon and your temperament as an investor. Ideally, and I can't speak for Ernest, but ideally for me, when I want to own all the companies that we own today forever, why would I want to sell them? Until we find a better idea or until that business it turns out to be not something we want to own any longer for a number of various reasons. If the fundamentals are improving, I want to hold that company. Are we able to model out a double-digit return for every single stock that we own going forward at any period of time? No, but we know that our companies are looking to grow and reinvest the cash flows in the future. We don't even know half the things they're working on. So we want to be patient with them and really focus, as you said, on our time horizon.
Well said.
All right, so you want to finish off the discussion on the acquisition from Tourmaline of Crew Energy and what's going on with that company?
That's a bit of a pivot from talking about Berkshire and Apple to talking about Tourmaline.
Well,
but Tourmaline Oil, which we've talked about on a previous podcast episode, they bought a smaller oil energy company called Crew Energy. Mm-hmm. And it's not a super material deal in the context of Tourmaline's overall size. But I think it was an interesting deal for a variety of reasons. Number one is that Tourmaline has had a great track record of buying high quality assets, so high quality inventory of natural gas and oil at depressed prices, which is where we currently are.
We are. The price of natural gas has been depressed, Ernest, now for about a year. 2 warmish winters in North America. Obviously, natural gas prices ran up at the start of the Russia-Ukraine war. They've really, pardon the pun, cooled off. And even though there's a lot of hype and excitement about building LNG plants, which should move low natural gas prices in North America to countries that don't have natural gas, that should be beneficial, as well as everybody talking about the off-the-charts demand for electricity. Did you read Bruce Flatt's letter to shareholders? Bruce Flatt, the CEO of Brookfield, talked how excited he is about the demand for electricity. That's over the next 20 years. Like he says, we're not even close to being prepared and the amount of spend that's going to happen. And as a result, you need bridge fuels. Bruce Flatt talked about we need more nuclear power. I don't know if that's going to happen. But wind and solar, they're great. We want to save the environment, but that's not going to cut it for all the demand that's needed.
And the rationale for Tourmaline buying a company like Crew is that Crew Energy is a smaller company, right? And what that means is that, and the reason that this matters is because Tourmaline, as a larger producer, they have the ability to go out and sign marketing deals. So they have to, basically, in plain English, what this means is that they can sell their natural gas in a variety of markets to achieve higher pricing than the local AECO price in Alberta.
That's right.
Which is generally a very depressed price for natural gas. They sell in California. They sell some in like the Japan, Korea liquid natural gas pricing market. They sell all over the U.S.
They could also sign deals with chemical companies and LNG plants because they have more. These companies are looking for guaranteed supply.
Right.
And a small company just can't do it.
And so for someone like Crew Energy that has, they have good land, they have good reserves, but they just don't have the scale to be able to, number one, like complete major expansions at an attractive price. Mm-hmm. And they don't have the ability to negotiate these marketing agreements.
So there are economies of scale in a commodity-based business.
And so Tourmaline is, we think the stock is attractive, but the multiple is higher than these junior oil and gas companies because of their track record.
Also, it's terrific balance sheet. I think it has next to no debt, maybe a little bit. And you're probably paying up for one of the best energy managers in the world, Mike Rose.
Yes. And so they are using their equity. This is largely equity. They're issuing equity of a premium asset to buy shares of Crew Energy at essentially the value of their proven reserves. And they're going to generate a lot of synergy from the marketing. They're able to increase their production into LNG Canada next year. Yeah. And there's also some tax benefits that they're inheriting. So all in all, I think
the deal is good.
Good deal's good and evidence of a well-run business.
Yeah. So one thing, of course, that Tourmaline can control is the price of natural gas.
Yes.
And so the share price, of course, has been languishing as a lot of oil companies prices have kind of not done well recently because the price of oil and natural gas has come off. Why? Well, the supply has increased. Many are worried that the world economies are slowing down, for various reasons, right? Or those assets are also speculative assets, financial assets. So you never know what the true supply demand is for those products. But, for Tourmaline to do well here, of course, eventually it needs natural gas prices to recover to a more normal level. That may or may not happen, but as a long-term investor, we shouldn't worry too much about what the price of natural gas is going to be next week, next month. We should worry about, are they building a company that is sustainable for the future?
And a common pattern that we see with really, really great companies is that they are able to use depressed market conditions to make acquisitions. Yeah. And that's whether it be like Couche-Tard, TFI International, right? Whether it be whether it be Canadian Natural Resources or Tourmaline Oil, like that's what they're doing, and that's exactly what we want to see.
Beautiful. So we'll end it there, and we'll see you back here real soon. Thank you very much for joining us.